Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to cover IFRS 15, a revenue from contract with customers. We are going to divide the session into 2 or 3, depending on the timing, because I don't want to spend above an hour per session. So, today, we are going to look at the fundamental concept that you need to know about IFRS 15. So, firstly, we need to understand what is revenue, which is very much important. In simple, for us to understand what is revenue, we need to know the basis of operation for any company. For instance, if the company is producing mobile phone, then therefore on the disposal of mobile phones, then we are going to recognize a revenue because our principal activity, the reason for existence, is to produce and sell the mobile phone. If the company is producing a pure water, then whenever a sale is made to customers, then it means we are going to recognize the revenue. Also, if a company is producing computer, or within the computer they produce a maintenance facility as well, or a software that will be used in line with the computer. So whenever a sale is made to a customer, at that particular point in time, we need to recognize a revenue. So whenever we are talking about revenue, we are looking at the principal activities of the company. If the principal activity of the company is to manufacture or to mine gold or minerals, then whenever there is a sale on that particular, natural resources, then the company should recognize the revenue. So basically, this is the concept that you need to know about revenue. In further aspect, when we are going to look at example on the banking industry, their major revenue generating stream is from deposit or the repayment of loans and advances. So, you might be thinking as to whether we are going to recognize that as a revenue or not, or whether we are going to account for it under IFRS 15. We are going to look at it during this session. So now, when we are talking about IFRS 15, it provides a single principle-based model for revenue recognition. How, when, how are we going to recognize? When are we going to include the revenue, the sales from customers in our financial statement? So this is exactly what IFRS 15 is about. For instance, a company that's producing pure water, whenever a sales is made to its customers, we need to know at what particular point in time are we going to recognize revenue. We need to determine the cutoff. Also, for example, if we are producing a computer, and also providing a 1 year maintenance service for that particular computer, along with the installation of software. So if we are looking at how we can recognize revenue in this particular situation, we are going to look at the concept that we need to consider as to whether we are going to recognize the sales of the computer, the maintenance facility, as well as the software as a single performance obligation, or whether we are going to recognize it as a separate, performance obligation, which means we are going to recognize the sales from the revenue separately, from the computer separately, from the maintenance separately, and from the installation separately, or whether we are going to recognize it as a single performance obligation. So also we need to know at what point in time, because the sales of the computer, will be completed on the day we are going to transfer, we are going to give out the computer to customer. Whilst when it comes to the provision of maintenance and installation of software, it might require a significant amount of time, for instance, a year, before we are going to do the particular repair or maintenance, or it might possible that we are not going to do the repairs or the installation at all. So we need to determine at what specific point in time that we are going to recognize revenue from contract with customers. So this is what we are going to look at under IFRS 15. And also it is a very important accounting standard for everyone as an accountant to be aware of. You need to know how you can recognize your revenue, because if your revenue recognition is not correct, then it has significant impact on the whole component of the financial statement. It will affect our gross profit, it will affect our operating profit, it will affect our profitability, it will affect the taxes that we are going to pay to government, it will affect our overall distribution of wealth to shareholders, as well as it will impact our performance. So therefore, we should not overstate our revenue to show a clear picture, to show a better performance. So this is why IFRS 15 was adopted, so that we can have a single principle-based model for revenue recognition. So we need to aware that we are not going to apply IFRS 15 to leases. When we are going to look at leases separately, IFRS 16, we are going to look at the right of use assets, as well as the lease liability, or we are going to look at the short-term lease. Then also for financial instruments, as I mentioned earlier, if we are talking about the banking industry, we are not going to use IFRS 15 to recognize the money that they generated from the deposit or from the loans and advances. Instead, we are going to use IFRS 9 financial instruments to account for these revenues that the banks are generating. Also, we are not going to apply IFRS 15 to insurance contracts. When we are going to look at IFRS 17, we are going to look at insurance contract, and all non-monetary exchanges, we are not going to use IFRS 15. For you to understand monetary exchanges, you can go back to IES 21, foreign exchange. You can have some concept relating to monetary exchanges. So now we are going to look at the core principle about IFRS 15. The revenue is recognized when control of goods or services transferred to the customer at an amount that reflects the consideration expected. So this is the core principle. We are only going to recognize, going to include the sales to customer in our financial statement when control of goods or services has been transferred to the customer. Anyway, we are going to look at it in detail. So for now, you just need to understand that we are going to recognize revenue when we transfer control of goods or services to the customer. So for this level, we are going to look at the five approach, the 5 steps in revenue recognition, which is very much important. We need to understand the content of each of the various steps, because especially for strategic business reporting students, you need to understand the step-by-step approach, because when question will be tested, it is possible for the question to be on the contract, the step one. The question might ask you to explain the accounting treatment. So you need to know, whether the step one, whether there is a contract or not, before you are going to proceed to step two. And also for financial reporting students, you need to aware of the content of the various steps. So now, according to IFRS 15, the revenue recognition, there's a 5-step process. Before we are going to recognize revenue, these 5 steps should be assessed, should be present, before we are going to recognize revenue. So now, the step one is we need to identify a contract. We need to establish a clear contract, a clear agreement between 2 or more parties, that can create an enforceable right and obligation. So now when we are talking about contract, it means between the company and its customers, there should be a contract, whether it is in written, whether it is oral, or whether it is on customary business practice. But the bottom line should be there should be a contract. Why there should be a contract? Because if there is any breach from either party, let's assume the company fail to supply the goods to its customers, then it means the customer has the right to take legal action against the company. But we can only take a legal action if there is a contract between the company and its customers. On the other hand, if the customer fail to pay the company for goods that has been supplied to that particular customer, then the business has the right to take the company to court for damages. So without the contract, you know, both parties will not have any enforceable right and obligation. So therefore, this is the first important step that you need to know as a student. There should be a contract. An entity can only account for revenue if the contract meets the following criteria. So you need to note this point down. First criteria, the parties to the contract, the business and its customers have approved the contract and are committed to perform their respective obligation. So it means the contract should be approved via whether it's via mail, whether it is written, whether it is a phone call, but there should be an approved contract. The contract will give the commitment to perform their respective obligation. The contract will state that you need to supply 10 bottles of water to X supplier, and X supplier have to pay in 2 months' time, 3 months' time, or whichever period, have to pay this amount of money to the company for X, Y, and Z number of bottles that is supplied to this particular customer. So we need to show the commitment to various respective obligations. Second condition, the entity can identify each party right regarding the goods or services to be transferred. We need to clearly establish, we need to clearly state what are we going to transfer to the customer and at what amount the customer is going to pay. So we need to define, we need to know the right relating to the goods or services that we are going to transfer to our customer. So this should be contained within the contract. The third point, the entity can identify the payment terms for the goods or services to be transferred. It is very clear. We need to know the amount that we are going to pay for 10 bottles of water. We need to know the amount we are going to pay for the mobile phones, for the computer. It should be clear. It should be stated clearly. Another point, the contract should have commercial substance, which is very important concept that we need to know. When we are talking about commercial substance, it means the business the business should benefit, should generate a future cash flow from that particular transaction. If the business cannot achieve any future cash flow in terms of timing, in terms of amount, and in terms of risk management, then it means that particular transaction is not commercially viable. So we are not going to account for it as a contract. So the very important point that you need to know, the contract has to be commercially substance. It should be commercially viable. The final point, which is very much important, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to its customer. So it is very clear there should be a greater than 50% chance that the customer will be in a better position to pay us. What this is saying, it means we should not do transaction with customer who might have issue with compliance, issue with regulation, or might have some going concern issues. For instance, there has been lots of for the previous operational period, the company has been making losses. So we need to do some due diligence tests on our customers to ensure that they are in a better position to pay us if we go into transaction with that particular customer. So this portion of the contract is telling us that we should not go into agreement with customers if the customer has a higher propensity of not paying us our money. So it should be greater than 50% chance that we are going to, collect the amount that, that will be agreed as per the contract. So for us to consider a contract to be valid, for us to consider the contract between the company and its customers to be valid, these points should be present within the contract. Anyone that is missing, then we can't account for that particular transaction as the well-defined contract according to IFRS 15. Then we are going to look at how we can account for it. So we need to know these points. So now let's look at illustration 1 so we can understand better. Timaco has a year ended of 31st March 20x6. On 1st January 20x6, Timaco signed a contract with customer to supply them with an asset on 31st March 20x6 in return for payment of $360,000 on the 30th of September 20x6. Now let's try to understand the question. On 1st January, the contract was signed between Tima and its customer to supply an asset on the 31st of March 20x6. This is the date that we are going to transfer the asset to the customer. This is the date where this is the date where we are going to, this is the date at which we are going to transfer the control, the liability to the customer. Then we are going to receive payment of $260,000 on the 30th of September 20x6. March, April, May, June, July, August, September, 6 months after the transfer, after the control has been transferred to the customer, that's the time we are going to receive payment for that particular asset. Control of the asset passed to the customer on 31st March 20x6. By 31st March 20x6, as a result of changes in economic climate, by 31st March 20x6, as a result of the changes in economic climate, Timaco did not believe that it would probably be paid the $360,000. So we need to know whether there is a contract or not. It is obviously not that there is no contract. Why? Because if we are going to look at the probability criteria, by the 31st of March 20x6, as a result of the changes in economic climate, which is it's a natural issue. This is an indicator of going concern. This is an indicator that the business, the customer, it is not at a better position to pay this particular $260,000. So because of this particular indicator, it means that it is not probable that we are going to receive this amount, from this particular customer. So we can't classify this illustration as contract. So we are going to look at the second phase of the stages. The second stage is the identifying the separate performance obligations within the contract. Now, when we talk about the performance obligation, in simple terms, this is the reason why we are going into the contract agreement. For instance, if the company, is to supply X quantity of pure water to its customers, then the performance obligation is the pure water that we are going to transfer, that we are going to sell to our customer. If it is computer, the performance obligation is computer. So we need to know, we need to be in a position to identify the separate performance obligation. In a situation where we sell computer to customer, as well as we provide a repair or maintenance, or we provide an installation service, we need to know, we need to identify whether these services are part of their performance obligation or if they are separate performance obligation. So the step 2 is telling us that we need to identify if the computer, the service, and the repairs is a single performance obligation, or if it is a multiple performance obligation. We need to identify this phase in the stage 2 of the revenue recognition. So performance obligations are promises to transfer distinct goods or services to a customer. A goods or services is distinct if customer can benefit from its own. It is separately identifiable from other premises. Now, as I mentioned earlier, if we are talking about the sale of computer as well as the provision of 1 year repairs and installation of software to the customer, if we can, if the business can sell the computer separately, as well as if the business can provide the service separately, distinctly, then it means these performance obligations are separate. We should not recognize revenue on combined performance obligation. We need to identify the distinct performance obligation. So now, let's assume the company produces pure water, as well as part of the contract, they provide a free delivery for certain quantity of water that is purchased from the business by its customers. So now, if the free delivery service is provided to the customer, it might be tempted that this delivery service is a is a separate performance obligation. So you need to know the essence of existence of the business is to produce a pure water. The business is not doing a delivery service separately, as a services on its own. The business strategic objective is to produce a pure water. The basis of providing the free delivery is to motivate customer, is to maintain customer relationship and to ensure there is an increase in the sales and availability to its customers. So now, since the business is not doing any form of delivery as a business model on its own, they only do the delivering because of because of motivating the customer or because of building a strong customer relationship. So in this particular dispensation, we are not going to account for the delivery service as a separate performance obligation. We are not going to include it. We are going to account for only the sales of the pure water to its customers. So we need to know whether the goods or services are distinct. Then, if the goods or services are distinct, then it means we need to account for this performance obligation separately. So, example of distinct versus non-distinct: phone plus mobile data plan, they are distinct. No distinct: installation, including machine delivery, integrated into one obligation. It all depends. If we can sell the phone separately and if we can sell the mobile data plan separately, then it means the products are distinct. Now, for the installation, if we are providing installation as part of the integrated process to support our customer, to maintain customer relationship, to upkeep our customer, to retain our customers, then it means we should not account for this as a distinct performance obligation. We are only going to account for the sale of machinery as a single performance obligation. So you need to note this down. In an examination, you need to be in a better position to identify these performance obligations. Now, some contract contains more than one performance obligation. For example, an entity may enter into a contract with customer to sell a car, which includes 1 year free servicing and maintenance. This is a separate performance obligation because we are going to sell the car and also we are going to provide a free service and maintenance facility. But now, what you need to know, if the company can sell the car in isolation and also parts of the sales, the company can provide, free servicing and maintenance separately, then automatically this is a distinct performance obligation. And what I'm saying, if you go to X company that produces motor vehicle, I can buy the motor vehicle from the company, which is clear. Then also, if I don't want to buy, I just want the motor vehicle company to provide me to provide me a servicing and a maintenance facility on my own car that I did not purchase from them, or I did not purchase from them. So in this situation, since the car company is providing separate servicing and maintenance, excluding the sales, then it means these performance obligations, they are distinct. They are not the same performance obligation. So we need to account for revenue, separately. An entity might enter into contract with customer to provide 5 lectures, as well as to provide textbook on the first day of the course. The distinct performance obligation within a contract must be identified. We need to identify it. It's very much important. Performance obligation may not be limited to the goods or services that are explicitly stated in the contract. An entity customary business practices, published policies, or specific statements may create an expectation that the entity will transfer goods or services to the customer. So we need to note that point as well. Another point, an entity must decide if the nature of the performance obligation is to provide the specific goods or services itself, the entity is the principal, or to arrange for another party to provide the goods or services, the entity is an agent. So now, in a situation of principal and agent relationship, if the business is playing the role as an agent, then according to IFRS 15, we are going to recognize revenue based on the commission, based on the fee that we are going to receive as an agent. Period. I'm not talking about the principal. The principal, it's fine. You're going to recognize revenue on normal basis. But when it comes to the agent, we are not going to recognize revenue on normal grounds. Revenue will be recognized based on the fee or the commission that you are entitled to. Now, let's take a look at this example, this illustration. Turban Co. revenue includes 45,000 for goods it sold acting as an agent for Med. Turban Co. had a commission of 10% on the sales and remitted the difference of 4,500 included in the cost of sales to Med. How should the agency sales be treated in Turban's statement of profit or loss? Already, from the question, the $45,000 has been included in the revenue figure of Turban, and Turban is playing the role as an agent. So by right, it should only include 10% of the 45,000 as a revenue. So now let's do some calculation so we can able to understand, right? And on normal grounds, what should have been done? We need to recognize revenue based on the commission of 10%, which will equals to 4,500 dollars. But from the question, the $45,000 has already been included in the revenue figure. So we need to do the correction. So what we are going to correct, we are going to ensure that this 4,500, we debit the revenue and we credit the cost of sales because it has already been included in the cost of sales. So we are going to debit revenue by 4,500, and we are going to credit cost of sales. We are going to credit cost of sales by 4,500. So this will be the solution to this illustration. So our third step, which we need to know as well, we are going to look at determine the transaction price. We need to know the price, how we can determine what factors are we going to consider, what are we going to include as part of the transaction price, and what are we not going to include. Very important concept that you need to know. And the transaction price is the amount of consideration to which an entity expects to be entitled in exchange for the transferring promised goods or services to customer. Amounts collected on behalf of third parties, such as sales tax, are excluded. We are not going to include sales tax. The consideration promised in a contract with a customer may include fixed amount, variable amount, or both. When determining the transaction price, an entity shall consider the effect of all of the following. Very important, we need to know. Firstly, we need to consider the variable consideration as part of the transaction price. We need to consider whether there's a significant financial component in the contract or not. We need to look for non-cash consideration, and also if an amount is paid to the customer to maintenance or to update their facility or their store before the goods are transferred, then we need to deduct this particular amount from the transaction price. So now we are going to look at variable consideration. What do we mean by variable consideration? The amount of consideration receivable within the contract can vary depending on certain conditions, depending on the incentive, depending on the bonuses. For instance, a contract to build a house, you know, the stipulated period, let's assume it's 2 years, but now we can state that if the client, completed the building within a year, with all safety and regulatory standard compliance with, then it means we are going to give this particular amount to this particular business. So that performance bonus that we are going to assert to that particular performance objective, we need to look at this as a variable consideration. Very important. For example, an amount of consideration will be variable if either a product was sold with the right to return. Very much important when we are going to look at another concept. For instance, within the sales agreement, if the customer has the right to return any default product, then that is a variable consideration. So it might affect our transaction price or not. It is possible that we have a return, or it is possible that we did not have any return, or a fixed amount is promised as a performance bonus, as I already mentioned, if certain conditions are achieved. Short as timely completion of construction, very clear. So if the consideration promised in the contract includes a variable amount, the entity, this is what you need to know. The entity estimates the amount of the consideration to which it is expected to be entitled. You need to do an estimate. For instance, if we are talking about a sales that is made to customer with the right to return, we need to look at the past statistics of returns. Then, based on the past statistics of return, we can do a rough estimate that this amount from the sales transaction will be returned to the business. So we are going to ensure that within our transaction price, we include this particular estimated consideration. This The method of estimation will depend on the potential outcome. Very clear. For example, if there are only two possible outcomes, an entity either achieve a performance bonus or does not. It is clear. The amount will be determined at the most likely outcome. For instance, if we are talking about performance bonus, if the construction process is completed within an year, which will be completed in 2 years, then it means you are going to get this particular bonus. It is clear. Either you get the bonus or not. So if the construction is completed within the year, then you will have the bonus. If the construction is not completed within the year, you will not get the bonus. So on this basis, then we are going to use the most likely amount. On the other hand, if an entity has a large number of contracts with similar characteristics, then the expected value calculation will be appropriate. So if there's a situation where we made a sales to customer with the condition that they have the right to return X or any default product, for instance, then based on the past experience, based on statistics, based on the previous returns, then we need to use the expected value to calculate the appropriate amount that we are going to account for as a variable consideration within the transaction price. Another concept we need to know is the financing component. Very important concept that we need to know. The financing component will be divided into two. One aspect of the financing component, if there is a significant timing in terms of the payment by the customer, then we are going to account for the financing component. Or if it provides, a financing benefit, then we are going to account for the financing component. Now let's understand the concept. In determining the transaction price, an entity must consider if the timing of payment provides the customer or the entity with significant financing components. For instance, the business went into contract with its customer to supply, pure water, and the payment will be made in 2 years' time. Automatically, since there's a significant, you know, timing when we are going to receive the payment, then it means this is a financing component. It means we have provided a loan to that particular customer. So we need to know how we can account for that particular transaction. We need to know how we can effect that particular transaction within the revenue recognition. Also, if there is a significant financing component, then the consideration receivable needs to be discounted to present value using the rate at which the customer will be able to borrow. The value of the revenue recognized is the present value of the consideration. Very clear. We are going to look at example to properly illustrate this particular question. The discount is then unwind until the payment is received. Now, if you can remember when I covered IAS 16, the dismantle cost, we are going to um, discount it to present value, then we are going to ensure we unwind that particular amount. This is the same concept, just that the accounting treatment will be different. So now, we recognize the interest as a financing income and increase the amount of receivable. The following may indicate the existence of significant financing components. You need to note this point down. This point will determine whether there is a significant financing component or not. A difference between the amount of promised consideration and the cash sales price of the promised consideration. Now, when we are going to look at the next step, the step 4, we are going to understand this first bullet point. Now, let me just give you a background. For instance, if a company is producing computer as well as providing an installation software or 1 year maintenance service for that particular computer, right? If the company can sell the computer separately and if the company can provide the service separately, then it means there should be a standalone selling price for both products. So it means if there's a standalone selling price, then the performance obligations are separate. They are distinct performance obligations. So now, let's assume a customer wants to purchase the computer as well as the services, but the amount is $10,000, for example. But if you want to buy the product separately, let's say the computer costs 9,500 and the repair and other services cost 1,000. So if a customer wants to purchase it separately, then it will cost 11,500. But if you want to buy it as a single component, it will cost you 10,000. So automatically, if there is a difference between the promised consideration, hmm, if there's a difference between the promised consideration and the cash sales price of the promised goods and services, then there is a significant financing component. The 5,000 in excess, is a financing component. The next step, we're going to look at how we can allocate, these financing components to the various products, to the various performance obligations. First condition. Second condition, a significant length of time, 1 year or more, between the transfer of the promised goods or services to the customer and the payment days. As I mentioned earlier, we made a sale to customer pure water, and the customer will pay us in 2 years' time. So it means there's a significant financing component. So we need to know what we are going to do. So with these factors will be used to determine whether there's a significant financing component or not. Then if there's a significant financing component, especially when it comes to the significant length of time in between the date we are going to transfer the liability, the date we are going to transfer the control, and the payment date, then we are going to discount this amount to present value. Then we are going to unwind the amount so that we can increase our receivable, as well as we are going to increase our financing income. So now, without wasting time, let's solve this illustration. Very important concept that we need to know. Let's solve this illustration, right? Illustration. Let me go to my notepad. Let me paste the question. Okay, just a minute, please. Wow, not working. Okay, okay, very good. So, um, so very good. And Kim and Co enter into a contract with customer. The requirement stated that explain how this transaction should be accounted for in the financial statement of Kim and Co for the year ended 30th September 20x3 and 20x4. Very simple. K Co enter into a contract with customer to supply furniture on 30th of September 20x3. This is the date that we are going to transfer the liability. Control of the furniture transferred to the customer on that date. So on the 30th of September, we are going to transfer the liability. And according to IFRS 15, we need to identify the date that we are going to transfer the control. At that particular date, that date we are going to use to recognize the revenue. The price stated in the contract is $750,000 and it is due for payment on the 30th of September 20x5. So let's note the point down, right? Let's look at note. Very clear, right? The control date is the 30th 9-month 20x3. The amount is $750,000, right? Then also the payment date, very important, is equals to the 30th 9-month 20x5. Sorry, 5. So it means from the 1st of October 20x3 to the 30th of September 20x5, 20x4, 20x5. So it means 2 years. The payment term, the payment duration equals to 2 years. So therefore, this is a significant financing component. Then according to IFRS 15, we need to discount this amount to present value. So now we are going to do our working. We are going to discount this amount to present value, which is very clear. Let's do the working over there. And then the rate that we are going to use is 7%. So now the discount factor will be the present value will equals to the future value times 1 upon 1 plus r raised to the power n. You can look at my IAS 16 video for a better explanation of the formula, the discount factor. So we can keep it simple. 750, which is the value that we are going to receive in 2 years' time. Now, the concept is telling us that we are going to receive $750,000 in 2 years' time. But now we need to account for revenue on the 30th of September 2023. Now, according to IFRS 15, the revenue should be recognized on the date the control is transferred. And based on the question, the company came and will transfer the furniture to the customer on the 30th of September 2023. So at that particular point in time, we need to recognize revenue. We don't need to wait until we receive the amount before we are going to recognize revenue. So if the amount that we are going to receive is 750,000 in 2 years' time, we need to know the equivalent amount that we are going to receive today, as of the 30th of September. What will be the amount that we are going to receive? So now it will be 1 divided by 1 plus 7% raised to the power 2, which is n. So now let me use my calculator to calculate the discount factor. Calculator. So it will be 1.07. Oh, I don't have scientific calculator. Okay, very good. Okay, 1.07 raised to the power 2. Then it will give us 1.1449. So 1 divided by answer, 1 divided by 1.1449 will give us a discount factor of 0. So it will be 750,000 times 0.8734 to 4 decimal place. Then therefore the answer will be times 750,000 will be 655,079, for example, right? So therefore this will be the amount. So what are we going to do? Sorry. Okay. So now very good. So now we are going to the double entry. Let me use black. We are going to debit and we are going to credit. So now we are going to debit receivable and we are going to credit revenue, equals to 655,079 equals to 655,079. First aspect of the question. And the second phase we need to know, we are going to unwind, because in 3 years' time we are going to receive $750,000. But as of now, we only recognize revenue of 655,000. So therefore, there is a difference between what we have recognized and what we are going to receive in 2 years' time. So we need to account for that particular difference. And this is the concept of unwinding. So we are going to unwind this particular amount so that we can increase the receivable balance to 750. So when we are going to unwind, we are going to use the interest rate, which is the interest rate of 7%, multiplied by the closing receivable. The closing receivable. This is the same concept as per IAS 16. So times the closing liability, the closing receivable balance is 655,079. So therefore, year one, this is the finance cost year one, and year two. So therefore, this will be multiplied by 0.07 will give us 425,855, for example. Then in year two, 7% multiplied by the closing liability, which is, closing receivable balance 655,079 plus 45855, which will equals to 45855 plus 655,079 multiplied by 0.07. So this will give us 49,065, right? So now what we are going to do for the unwinding, the double entry for unwinding, we are going to debit and credit. So what are we going to debit? Very important. And what are we going to credit? We are going to debit the receivable so we can increase our receivable. At the end of the year, at the end of the 2 year, we are going to receive an amount of $750,000. So we need to increase the receivable by debiting the receivable. Then also, we are going to credit the financing income, not revenue, but the financing income. So for year one, we are going to 45855, and year two, and 45855 for both, and year two, very good. Sorry. Crystal clear. Oh, okay. Some technical failure. So we can proceed. So for year two, um we are going to debit 49065, the receivable, and we are going to credit financing income of 49065. So at the end of the day, we are going to get 750,000 plus or minus rounding error, 750,000 for the receivable that we are going to receive in 2 years' time. So basically, um, this is the concept of IFRS 15 relating to the consideration, the financing component. So now we are going to look at consideration payable to customer. For instance, if consideration is paid to customer, this is the payment that will be made from the company to its customer. If a consideration is paid to a customer in exchange for distinct goods or services, then it is essential a purchase transaction and should be accounted for in the same way as other purchase from suppliers. Assuming that the consideration paid to a customer is not in exchange for a distinct goods or services, then an entity will account for it as a reduction in transfer price. So now what the concept of consideration payable to customer is saying, for instance, if the customer is, is a supplier to us, for example, we are producing a pure water, the customer that we usually sell the pure water to, might, at a particular point in time want to, supply us, for instance, the bottle that we are going to use to brand, to package the water. So in this particular situation, if the goods is distinct, we are not going to account for it as a deduction from the consideration. We are going to treat it as a separate purchase. We are going to treat it as a transaction from supplier, though it is our customer. But at this particular point in time, since the goods or services is distinct, then we are not going to account for it as a consideration payable to customer. But on the other hand, if the customer is not in exchange of a distinct goods or services, for instance, um, we want to sell this, let's say 100 bottle of water to a customer, but currently the customer did not have a storage capacity that can contain the bulk quantity the customer want. So we decided to help. We decided to expand on the storage capacity. We decided to give the customer money to expand on the storage capacity. So in this regard, we need to consider this as a deduction from the transaction price. So basically, this is the concept. During our live online session, we are going to solve illustration 4. So for now, we can stop um, we can stop from step 1, 2, and 3. In our next session, we are going to look at step 4, which we are going to show how we can allocate the transaction price to the various performance obligation. So thank you all for your time.